Now let's talk more about the bond market. Government-backed mortgage bonds are underperforming treasuries by the most this year amid concern that refinancing will accelerate. At the same time, supply of corporate bonds is shrinking. Joining us for a look at where investors should look to invest in the fixed income market is Mitch Stapley. He's Chief Fixed Income Officer at Fifth Third Asset Management, which oversees $22 billion in assets. Mitch, thanks for joining us. Appreciate it.
Great to be here.
So let's talk first of all about what's going on in the mortgage bond market. There's been a lot of talk among mortgage traders. We were just talking with Dom Chu on our markets desk about this, about concern that the administration is going to come in and do some sort of borrower loan forgiveness. So talk to me about what you're hearing and what the feeling is in the mortgage market as a result.
Well, one of the things that's really been weighing on mortgages here is the notion that with that 2.63 yield you've got on a 10-year, you've got 30-year mortgage rates, 4.25%, something like that. There are a lot of 5.5%, 6% mortgages out there that could be refinanced. Well, the premium on those bonds, if you look at it, they're probably trading at 102, 103 or higher premiums. So all of a sudden, those bonds, which were trading at a premium because of the higher coupon, would basically get paid off at par. Okay, so that's good news for the homeowner, who's going to have a lower payment, but it's really bad news for the bondholder who's got that premium bond, and all of a sudden it goes from, say, 105 down to par. So that's the issue out there and the concern, because pretty much the entire mortgage universe out there right now is trading at a premium. So if you start taking those premiums and wiping them out, somebody's got to take a hit, and that's the question out there right now. Would the administration come in and unilaterally say, okay, the bondholders out there have to take the hit to benefit the current mortgage holders, the homeowners? Now,
just to make sure I'm sort of clear on this, Mitch, I mean, why aren't these people refinancing anyway if they can get these much lower rates? Why do they need the administration catalyst to do so?
Well, the problem is, with the housing correction that we've had out there, you've got a lot of people that are upside down on the mortgages out there right now. They simply don't have the home price that they need to go out and qualify for a refinance on their mortgage. So it's the decline in home prices that's keeping them from being able to refinance.
Now, I know that you're looking at this through the prism of the fixed income market. You're not an administration analyst, so to speak, or a political analyst. But what do you think the likelihood is of something like this happening?
This is a tough one to handicap. You wouldn't have thought what happened to General Motors and Chrysler in terms of their bankruptcy filing would have happened. When we politicize this issue under this administration, I mean, you can throw the rule book out. We don't think it's very likely to happen because two of the biggest holder of these outstanding mortgages that are trading at premiums right now are Fannie Mae and Freddie Mac. So in addition to the $150 billion that taxpayers have put into them already, it's probably a $30 to $50 billion hit to Fannie and Freddie to write those mortgages down as they'd be taken out at lower coupons. Think of the foreign central banks, the Bank of China, other central banks that own these securities, all the pension funds that have these securities. There's got to be a winner, there's got to be a loser here, and the diversity of the losers in terms of financial institutions globally makes it, in our estimation here at FTAM, a very, very tough sell. But again, nothing's off the table. Well,
so does that mean, though, if you think it's unlikely that you're getting into some mortgage bonds, if the perception out there is that it is likely and you guys think it's unlikely, I would imagine that you might be able to get some deals?
Well, I think it's one of the things we're beginning to look at out there. You've had a lot of volatility. We've been underweight in the mortgage sector for about the last 2 months. We basically, once the Federal Reserve stopped buying mortgage-backed securities as part of their effort to get the economy going again, we looked at that as a great opportunity to get out of mortgages. Now, mortgages have continued to perform, and just over the last month or so, we've seen this widening. It's beginning to create some opportunities out there, but we're not quite there yet. We're looking at the market. We haven't committed a lot of capital to it yet.
So let's switch gears and talk about the corporate market, because Bloomberg earlier in the week wrote about that there's a lot of demand. A lot of people come on here and talk about liking corporate bonds, but the supply is just not necessarily there. Is that a conundrum for you guys when you're looking at corporates?
Oh, absolutely. You've got a 2-year Treasury yielding you that princely 50 basis points. So if I could find a short corporate that's getting me 30, 40 basis points, and the Fed realistically is on hold, they're not going to be raising interest rates based on what we're seeing today out until 2011, that 75, 80 basis points can look pretty attractive. You have to go out there and find the supply, though, and it's been very tight. The amount of coupon income that investors need to reinvest, plus just the inflows that we've got coming into corporate bond funds from investors fleeing the equity market, that new cash coming in makes it tough. If you can find them, and you have to hunt around a little more, short CMBS securities, AAA CMBS, have been decent alternatives for us. Short ABS securities, but again, it's a supply issue. Very tight in those markets, an awful lot of demand. But those have been two places we can go besides just the corporate bond market to put some money to work.
All right, Mitch Stapley, unfortunately we're out of time. Lots to talk about with the fixed income market these days. Mitch Stapley of Fifth Third Asset Management, appreciate it.